One thing that I've come to believe is that technology can bring greater access to our capital markets. Our central question is this, though. When new technologies come along and change the face of finance, as they have done for decades, how do we continue to achieve our core public policy goals? In my role, I will always be animated by thinking about working families in the SEC's three-part mission: protecting investors, promoting fair, orderly, and efficient markets, facilitating capital formation. I'll just highlight a few of those key issues in this opening statement. First is gamification and user experience. I agree with the members who have already said these new user experiences have facilitated a lot for investors. They've expanded access to capital, making it easier for investors to sign up, start trading, learn about investing. These apps also use a host of features that have come to be familiar in our increasingly online world, such as gamification, behavioral prompts, and predictive data analytics. Many of these features, in essence, encourage investors to trade more frequently. The second topic I'd like to discuss is this area around payment for order flow. This practice brings to mind a number of questions, including whether it creates inherent conflicts of interest between the broker-dealers on the one side and their customers on the other who want to achieve, under our rules, best execution. Now, it's important to consider this, I think, in the overall context of market structure. Currently, a significant amount of retail orders are routed to a small number of wholesalers. I detail this more in the written testimony, but I think it raises questions about whether the market structure best promotes fair, orderly, and efficient markets. Evolving market technologies, along with this payment for order flow, has also led to increasing market concentration, which we've found, history and economics show, concentration can lead to fragility in markets, deter healthy competition, and limit innovation. The next issue is short selling and market transparency. And again, as outlined in the testimony, under Dodd-Frank reforms, the SEC received mandates and authorities to increase transparency in the market. So I'm not concerned about regular investors exercising their free speech rights online. I'm more concerned whether bad actors potentially take advantage of influential platforms. Further, is the decisions by some broker-dealers to redirect customer trading raised several issues around clearance and settlement. In essence, they stopped investors from investing. And this raises questions of the market, what I'll call plumbing. Sorry to Mike Bobson if I call the infrastructure plumbing. But investors were shut out. I do believe we can lower costs and risk in our market by shortening the settlement cycle. For instance, I've asked SEC staff to put together a draft proposal for the commission on the possibility of shortening the settlement cycles.
One effort that DTCC has undertaken to date, shortening the settlement cycle for equities from 2 days to 1 day. That may sound like a small thing, it's just 1 day, but cutting the settlement period in half can make a difference. We believe that shortening the settlement cycle to T+1 would enhance market resilience, reduce margin requirements, and lower costs for investors. Following a multi-year industry-wide effort, settlement was shortened in 2017 from T3 to T2, achieving margin savings estimated at 25%. DTCC estimates that the volatility component of margin requirements could potentially be reduced by 40% with a move to T1.
There's arguments on both sides as to whether to disclose what an individual investor is doing. Some say it's harmful, some say it's helpful, but there seems to be agreement that the aggregate information is helpful. We ought to know in aggregate how many people are, how many shares of GameStop are short. You generate that information, but you don't put it on your website. I'm told that you provide it to the exchanges and they publish it if they want to, and often behind a paywall. Why doesn't FINRA disclose all this information to everybody for free as quickly as you can?
Thank you, Mr. Sherman. That's a great question. I think we are, as we look at disclosure around short selling, I think there are some good arguments that we can do more here. I've asked our staff to prepare a regulatory notice to solicit comment on changes to FINRA's disclosure here to make it more frequent and more granular. And certainly as part of that, we can look at the way in which that disclosure is
Is there
disseminated.
any justification for what is a regulatory agency generating this information and giving it to private companies for them to sell rather than disclose it to the public?
I'm inclined to I appreciate the gist of your question, sir, and I'm inclined to be biased towards making it publicly available. I don't understand all the history behind how this developed. I think that's something we need to look into, but I commit to that we can certainly do that.
From the genesis of this process, I've been concerned about trading ahead. And you called to our attention earlier that nearly the one company, the largest market maker, executes approximately 50% of all U.S. retail volume. That's quite an amount for one firm to manage. And that causes a good deal of consternation, especially when this firm finds itself engaged in trading ahead. There are penalties associated with trading ahead, but these penalties are primarily civil penalties. And as a result of a civil penalty, many times there's no acknowledgement of liability, just a penalty paid. For example, in one case, $700,000 was paid. But that $700,000, while it seems like a lot, really isn't when we're dealing in billions, So as a result, I have been very much concerned, and I see that there is one proposed piece of legislation that would amend the Securities and Exchange Act of 1934 to prohibit trading ahead by market makers and for other purposes as well. This is something that I think has reached a point where its time has come.
I think that our current rules, you're correct, are civil, but our current rules are that if you take a customer order and then trade ahead of that, that's out of bounds, not allowed. And I think that's because the customer needs to come first, and in our market structure, that's what brokers are supposed to do.
I'm extremely concerned about what's going on in regulations and what we need to do to assure that social media doesn't take control of our lives and take it in a direction that could be detrimental to our democracy. Do you share that concern? And if so, what should we do? And how do we address the issue with that was just experienced with Metro Bank?
So I think that to the best ways we can is to be technology neutral, but recognize that technologies in each generation provide us new ways to communicate. Even as when the telephone came along and there were debates whether to allow the first telephone on the floor of the New York Stock Exchange. These are real debates that happened in the 1920s. I think technologies come along in the 2020s, and we have to ensure we still stick to our principles of investor protection, fair, orderly, efficient markets, capital formation. So we've got to lean in at the SEC and learn how to basically be a cop on the beat, so that free speech goes on, but if somebody's trying to manipulate a market or spoof a market or put fraudulent information into a social media channel, that we protect investors against that. But I think we constantly have to be evaluating, and to an earlier question even about regulation best interest, I said we're going to vigorously get the most out of regulation best interest, but we're also going to evaluate. I mean, if it's not serving the purpose of investors, then we will update and freshen that rule as well as other rules, because we always have to be evaluating that investors come first, align with our three-part mission.
So my first question is, do you believe it would violate federal securities law if a public company inserted a forced arbitration provision into its bylaws and governance documents?
And the SEC has said consistently to issuers, as I understand it, that it would be best not to put this into these corporate charters. And I think that the American public needs to be able to have redress to their courts. And that's a sort of a fundamental piece, to be able to go straight to the courts. And that's been true in terms of issuers for decades. And I think that's worked well.
What struck me the most about Robinhood's behavior regarding the GameStop frenzy was the seemingly arbitrary nature of its trading halts and the lack of transparency on the front and back ends of how and why Robinhood and other broker-dealers impose these restrictions. So Chair Gensler, not speaking specifically to Robinhood's situation, but broadly speaking, do you believe broker-dealers should improve their transparency with their customers about how and when they impose trading halts? And what role do you believe the SEC should play in improving these disclosures and ensuring trading halts are integrated into firms' risk management plans?
I think that probably what we could all agree on, that access to markets, whether you're an individual investor trading one share or a big institution, access to markets as they're moving up and down is a really critical piece of our capital markets. And what happened on January 27th and 8th was not good for millions of investors. So the transparency you mentioned is important between broker-dealers and their customers. And we've asked, and I think Robert Cook has said already that maybe they're looking at this too, is what's that transparency between and under what circumstances? And secondly, do they have, each of the broker dealers have enough liquidity to meet their requirements with the clearinghouse?
Mr. Meeks and I have also strongly advocated for measures to diversify the ethnic, racial, and gender composition of corporate boards and in executive ranks, because leaders set the tone and they set the priorities. From your perspective, does improving diversity on corporate boards bring a material benefit to companies?
Well, I can speak just in terms of what we're doing at the agency. And I do believe that diverse points of view, diverse backgrounds helps in decision making. And we're leaning into that in terms of building a senior leadership at the SEC.
Where I get concerned, though, is when you start talking about a lot of complexity and in particular leverage. So margin, option strategies that I'm really pretty certain that most of us, much less the average retail investor, doesn't understand. My question, I guess, for Mr. Cook and Mr. Gensler is there a point where you're employing leverage or synthetic leverage through margin or through derivatives that we should begin to think about restricting the ability of retail investors to employ those strategies? I don't need to remind the committee that we all know the story of Mr. Alex Kearns, who took his own life because he traded in some fairly complicated option strategies and discovered that he had created a liability for himself that he'd not anticipated. So my question is is there a line around leverage or complexity where we ought to not let the market teach tough lessons?
So I'll go first, and I'm sure Robert will want to add. I do think that our core is protecting investors, and for a long time we've said to open an options account, there was more discussion between a broker and that customer. Suitability used to be the words of the art, but and if I've got the words wrong, I apologize in my third week. But basically, they're taking more risk. I would also add, in terms of these apps, these applications that have made it easier to open accounts. In making it easier, we've lost that human in the middle saying, wait, is this appropriate? Is this risk appropriate? The thing that is like those buildings in Las Vegas and